Concerns over the health of the global economy now front and center for the market, certainly. But this was something that I brought up at the end of last year with Treasury Secretary Jack Lew back in December. He disagreed. Are you worried that the drop-off in oil will lead to job cuts and, sort of come at a time that we're already seeing this economic recovery just gain traction?
I actually think that the progress we've made in our economy is substantially greater than what you've described. You look at where we were 7 years ago, the economy was in a free fall. We were losing millions of jobs. We had an unemployment rate of 10%. We had a deficit that was skyrocketing out of control. Where we are now, we're seeing steady growth. We've seen enormous job creation over this period of time. We're seeing the unemployment rate around 5%, and we're seeing that growth in spite of the fact that there's a lot of headwinds from a slower global economy.
Okay, so that was about a month and a week ago. Joining us now, JPMorgan Asset Management Global Market Strategist, Gabriela Santos. Gabriela, good to see you. Thanks so much for joining us.
Thank you for having me.
6 weeks ago, Jack Lew is painting a very positive picture of the economy. I tried to push back about the knock-on effects that come with cheap oil, but he said I painted the wrong picture. So had things changed that dramatically in 6 weeks?
I would say that we're more on the Jack Lew camp. Really, we do see that, you have some headwinds for the U.S. economy. Slashes in CapEx spending from the energy sector, for example. You have a drag on trade, but you still have that consumer that's still holding in there. So that's one thing we're watching in order to see if this thesis is tested or not. But so far, we think growth is hanging in there.
So why do you think the markets are seeing a meltdown?
I think the concerns are about earnings. So the market is really concerned about the effect of energy and the effect of the dollar on earnings. And so the picture on the economy is a bit rosier than the picture for earnings.
Can you really isolate the two? I mean, when you've got weak earnings, that leads to companies sitting on cash and not creating jobs.
So far, we haven't seen that, right? We've seen a very robust pace of job growth every single month. But you're absolutely right. We are watching the extent to which the volatility and the sentiment does tend to, in the end, impact the job market. But so far, we haven't seen that.
So robust job creation, you're calling it?
We would call it that, yeah, absolutely.
They're very good numbers. I agree with you on that. You're in the 200,000 to 250,000 range. The problem I'm having, Gabriela, is the quality of those numbers and what the wages are in those numbers. The wages are up slightly, but not too much, and disposable income for the last 9 years is down about 9%. So why are you guys so positive on the consumer?
Well, I think that we see a lot of good positive tailwinds for the consumer. I mean, real income is up a lot, right? We have very low inflation. So just having that 2.5% wage growth is already a big boost. You have confidence levels that are very, very high, and you have a consumer that's very low indebted. And so the propensity to consume, we think, is still there.
So
I don't understand this confidence is so high, robust job growth. I mean, look at economic growth. You're talking about 2.5%. So I have to push back on all of the way that you're describing things. Robust job growth, confidence. Confidence is dropping in markets. I mean, you're looking at a global meltdown.
We're looking at a drop in confidence from investors and from the financial market, but you aren't seeing that knock-on effect yet on consumer confidence.
Gabriela, to your credit, the data is supporting what you're saying about the job growth. The jobs are there, which is why I think the market's trading down, because the market's looking at the job growth and the relative strength of last week's data, saying, hey, they could raise rates in an environment like this. Now, she's signaling otherwise because of the deflationary pressures around the world. Well, I guess my question is, the consumer has more money, they're saving more money, but I don't see the spending. And you guys are seeing the spending in your data?
We are seeing. So we have within JPMorgan our Chase Institute, which looks at actual bank accounts and spending patterns, and have found that consumers are actually spending 80% of the oil windfall. So I think it's tricky just to look at retail sales. That's being distorted by gasoline prices and other factors. But if you look at actual consumption expenditures, you are seeing growth there.
But you have corporations, and it's something Maria's talked about a lot, that are not willing to spend CapEx, that are actually laying people off. There were about half a dozen major U.S. corporations that announced 14,000 layoffs just in the last few weeks. The CEO of Moeller Maersk, the one one of the shipping giant, this is from earlier this week, said that it's seeing a massive deterioration in business that's worse than after the financial crisis, and that business is fundamentally changed, and the outlook is changing negatively for all of its businesses. That is, I think that people are why. Maybe it's a choice whether you look at a stronger consumer, but people are looking at the world and are very concerned about we're the last to fall.
Not to sound like a wonk, and I hear all of that, but the data is suggesting what you're saying, and that's what the big problem is. The market is not acting in line with the data. So the question is, if the market's not acting in line with the data, what's wrong?
But I do think the market is acting in line with the data, because the industrial side of the economy is in recession because of the commodities complex. Now, Gabriela, what you're pointing to is this JPMorgan Chase Institute data is showing that people are spending on T&E, right? They're traveling, they're going out.
They're spending on
experiences. Experiences. Why aren't they spending on stuff, on buying, in retail?
So I think one side is that experience. They are buying stuff. We can see things, for example, auto sales at the highest levels that they've ever been last year. But they aren't spending on the traditional retail kind of part of the equation. And I think that's part of the psychology post the financial crisis. People just aren't willing to spend like they used to in the past. And that's a good thing in the end, right? We don't want those excesses to build up. But nonetheless, they are spending.
And one could argue they spent literally decades buying too much stuff.
Exactly. We have enough
We're now
sweaters.
paying back for that.
So to what do you attribute then the market unease?
So I think, look, we are more, I would say, more optimistic with regards to the economy itself. We think the odds of a recession are lower than the market is projecting. But we are cautious in terms of the earnings outlook. And I think what we're watching, for example, is the strength of the dollar this year. We're watching energy prices, and we're watching whether companies are able to get any sort of revenue growth. So I would say we're cautious in the short term because of the earnings picture, but we aren't seeing that doom, that bear market, because we don't see a recession coming.
What variable would make you change your point of view?
Towards the economy?
Or negative. What would make you get more negative?
If you do see that impact on the consumer. So if you do see any sort of financial volatility or sentiment start impacting consumer confidence, business confidence, hiring, and spending decisions. And so, for example, today it'll be key to watch some of that retail sales. It'll be key to watch the consumer sentiment survey. And that's something we're monitoring. But so far, nothing to change our mind there.
All right, Gabriela, good to see you.
Good.
Thanks so much. Gabriela Santos, JPMorgan there.